Hi, and welcome back to the Interaxis YouTube channel and Interaxis.io. Today we're going to talk about cryptocurrencies as an asset class. And I have to make it very clear, I am not endorsing using cryptocurrencies as an asset class. I'm not endorsing that you actually invest in them. That's something you have to talk to your financial advisor about. I'm not giving financial advice here. I'm just explaining how I would look at them and how others are looking at them as an asset class, as something else to invest in. So, going forward, again, I'm not giving advice. I don't know how much more clear I can make that. Okay, next thing we have to do is talk about what is an asset class. So to do that, you have to determine whether you're an individual or you are an institution, whatever it might be. What are my investable assets? What do I have that I can actually put out there and either save or make money on or whatever? Okay, so let's just say I have $100,000 to invest. I need to determine how much goes into the, for lack of a better term, we'll call it the markets, right? The market is what we think of as the equities markets. Mutual funds, ETFs, money managers, stocks, bonds, whatever it is. That's in the market. How much goes into SAFE, emergency fund, whatever it might be. This is very important that it's liquid, right? Because this is, I need to write a check tomorrow. I need to use my debit card tomorrow. Something happens with my house. I need to replace the air conditioning. Something happens to my car. I need to be able to write a check for that. And ideally, I don't want to have to use a credit card and pay 20% interest, right? Not enough people in this country probably have safe or liquid assets. This is something I would keep in the bank, in a savings account or a checking account or something. I don't earn a lot of interest on it, but it's better than paying 20% interest to a credit card. Right? And then I might have other assets like, for instance, alts or alternatives. Okay? And alternative assets might be something like real estate. So I'm going to go here. Might be real estate. It might be, and real estate could be in the forms of LLPs, LLCs. It could be real estate investment trusts. We could have business development companies. BDCs are essentially funds where I put my money in. Some company, some manager is going to do whatever they do, whether it's lending money or investing in small businesses or whatever, and they're going to pay me back a return. All right, and that's all I want because they can do that better than I can. I don't have time to do that. Right here, you might have private equity, you might have hedge funds, whatever it might be, some other way of earning money. And why do we even do that? Right? Because if we look at overall your investment portfolio and how it grows, right? If you were looking at just market assets, right, and this is how a lot of people think of their investment. Believe it or not, overall, you don't want everything to be going up at the same rate at the same time. Because if your entire portfolio is going up like this, and that's your market assets and everything else, when they come down, they're all going to come down at the same time too, at the same rate. Okay, and the problem is, again, whether you're an institution or whether you're an individual investor, this might be the point where you need the money. And if you need to pull cash out here, I need to pull out $50,000 here, I don't let that $50,000 grow back. It's not an efficient use of my money necessarily. There might be other ways. On top of that, I just have to make sure that my assets are growing at different points. It might be that, my market assets go way up, but I want to keep a certain amount of my portfolio in the market. So if the market assets go up 10%, I take some of that off the table and I start putting it into other assets, right? So what I want potentially is my market assets here, and they might be growing like that. And at the same time, my alts might be here, right? So what I have is my total value is kind of in the middle. And I have my safe money in here too, right? But what that means is if the markets come down like this, my alts might go up, right? And so I still have that normalized, nice kind of curve of how my assets grow. Now, there could be a time where they all come down, but hopefully they don't come down at the same rate. So my entire portfolio, again, whether I'm an institution or an individual investor, is not crashing at the same time. That's the whole idea of this. So why do I want alternatives in addition to market and everything else? Why might I want that? Again, I'm not giving financial advice. Partially is to normalize. Partially what I want is something called a non-correlated asset, right? Non-correlated. And we look for that term, and you hear that term a lot in finance, non-correlated. Non-correlated basically means that if these assets, if market assets necessarily are going up, these might be going up, might be going down, might be sideways. It doesn't matter. These don't necessarily make these assets move one way or the other. They don't always move in unison, right? If they are exactly, if every time the market goes up, the alts go down, they are actually still correlated. It means that as this goes up, this goes down. Okay, that happens a lot of time. That happens exactly with bonds in terms of the yield versus the price of the bonds. They're correlated in that as the yield goes up, as the interest rate goes up, the value of the bonds go down. If you have this scenario and you're invested 50-50, your portfolio does that right in the middle. If they're exactly correlated, negatively correlated. What you want is non-correlated, right? You might want a time when your market assets go up, your non-correlated ones might do that, they might do that, they might do that, you don't know. But one doesn't necessarily mean the other is going to go in the same direction or exactly the opposite direction. You might want something that's non-correlated because, again, you want kind of a nice even curve, right? Because you might need the money at a different point. These assets, it can be said, usually are illiquid. Usually. Which means if I need to get this cash back out, I can't always do it. I a lot of times will get a higher return. I'll get, more, I don't want to say more guaranteed, but closer to a guaranteed return, just because of what they're investing in and their track record and everything else. But they're usually illiquid. I can't get my money out very quickly. So why might I see crypto as an asset class, and how might I look at it? I would look at it as a if I were looking at it from my own portfolio, okay, I look at alts, or I look at crypto as more closer to an alt. And the reason why is it's really not correlated with the market. It will probably move completely independently. That being said, cryptocurrency, the way it is now and the investments are now, really haven't had the time for us to have the right data to support whether they're correlated or not. We think they'll be non-correlated, but what we've seen is a lot of times it is correlated to what happens in different markets. But again, there hasn't been enough widespread investment and adoption to really see that.